So yay, we are on episode 3. Today's going to be a fun one, but you're going to have to follow me because some of it's going to get a little bit technical. So we are going to talk about, do we choose a Roth IRA, a traditional IRA, a brokerage account, which is just a regular account, not necessarily retirement? What are some of the benefits for each of these accounts and potentially some of the downsides? Now, might cover a little bit into the 401k and employer sponsored, but not as much because that's a lot of material to cover in one video session, basically. Remember that what we're talking about are broad strokes. We're going to get a little bit deeper into some of those broad strokes, but not everything applies to everyone. However, most of it will apply to most of you. So let's put up some things in writing that you could look at, and I'll go ahead and explain them as we're looking at them as well. All right, so the first thing we are seeing here is a chart, and let me walk you through it, because there's always, can I do something, and should I do something? So if you're doing an IRA or Roth IRA, both of them have both of them have a maximum amount you contribute of $7,000 per year. There is a $1,000 catch-up if you are over the age of 50. Now, when you're looking at where it says IRA deduction phase out for active participants, what they're saying is if you are actively in a 401k plan, so you're contributing to an employer-sponsored plan as well as contributing to an IRA, and you're doing a traditional, there's a phase out that's somewhere between $79,000 and $89,000. You cannot deduct your contribution to a traditional IRA. You could still contribute to it, but it's not tax deductible. If that contribution is not tax deductible, then I would probably recommend not necessarily making it in the account and looking if you qualify for a Roth. Now, where you see married filing joint, married filing separately, and non-active participant, married to a participant, that means if you have a spouse that has a 401k, but you don't, those are the phase out limits for the contributions. Now, if your company offers you a 401k, and you choose not to contribute, that still is going to affect your ability to deduct that contribution. Now, Roth IRAs, there is a phase out for income. So while a traditional IRA, you may not be able to deduct it, but no matter how much you make, you could contribute. With the Roth IRA, there's a phase out. So up to $150,000 of adjusted gross income, modified adjusted gross income, you can make a full contribution. Between 150 and 165, there are online calculators that tell you how much you can contribute. If you are married filing joint, that's between $236,000 and $246,000. So let's take a look at something else now to go over that as well. So I'm using Fidelity Investments website. I typed in Roth IRA versus traditional. And what you're going to see here is what it's talking about, that your deduction may be limited based on your modified adjusted gross income. Or for example, a hypothetical investor in the 22% marginal federal tax bracket could save an estimated of $1,500 in taxes if you're making your full $7,000 contribution and you're fully allowable for the deduction. Let's explain that. All right, so here's a breakdown. If you are single and you're filing your taxes, for you to be in the marginal 22% tax bracket, that means that your income needs to be, these are rough numbers for 2025, between $48,500 and $103,000. That means that your income, once you reach $48,500, only that portion is then taxed at the 22% tax bracket. before you're going to hit the 15% in the lower brackets. If you are married and filing joint, then it needs to be between $97,000 and $106,000. Now, the reason that this is important is a lot of people say, I'm going to contribute to my traditional IRA. I'm going to save $1,500 in taxes if I'm in the 22% tax bracket. And when I retire, I'm going to be in a lower tax bracket. False. Reason that is false is by the time you retire, you'll have Social Security. If you're married or if you're joint, you're still going to hit those income tax brackets with Social Security if it's still taxable. We're based on today's rules. You're going to have other investments, hopefully. So for you to still be in a high tax bracket is not unreasonable, especially if at some point in your career you're contributing to a 401k as well. But the other thing is you're taking your $1,500 tax deduction on your traditional IRA today. And if you remember in session 1, we showed how much that money could grow over the course of 20 or 30 years. So if those contributions continue doubling, you're basically, by taking a deduction in your traditional IRA, in the future, you could be paying taxes on hundreds of thousands of dollars versus going with the Roth IRA. If you qualify, remember there's income limits, that money will all be tax-free. So traditional IRA tax deferred, which means you're not paying taxes while it's growing. You're not paying taxes while there's dividends paid out, which is kind of an interest that stock pays out. You're not having to pay any taxes in that traditional IRA till the money comes out. Now in the traditional IRA, technically you won't start taking money out till 59 and a half to avoid penalties. There are a few exceptions that you can take the money out before 59 and a half and avoid the penalties. Those are very few. They're on the IRS guideline pages. We could discuss them at a later time. In a traditional IRA, you have to start taking out a minimum required distribution, also known as MRD or required minimum distribution, RMD. Either way, at 73, you will start taking out a certain percentage of it every year. So at 59 and a half, you can without the penalty. At 73, you must. When that money comes out of the IRA, because you deducted it, dollar per dollar, every bit of that is going to be taxed as ordinary income. So if you already had Social Security income, rental income, any other income sources, that's going to add onto the income and increase your tax bracket. In a Roth IRA, the money that you put in, you do not get a deduction today. But whatever you put in, as it grows, so you put in, your $50,000, $70,000, $100,000 into Roth contributions, and they grow and they become $800,000. Depending on the time that's in there, it's definitely feasible that could happen. That entire sum comes out tax-free. That's correct, tax-free. You take the money out of the Roth IRA, based on today's laws, you don't owe $1 tax on it, which is substantial. Especially as you're planning for retirement, it's all your account. It's not that part of it's going to go back to the government in taxes. But here's the other thing. In a Roth IRA, if I've contributed, and let's say 6-7 years from now, I'm like, oh no, I need to take some money out of this Roth IRA. You can always, regardless of your age, access the principal that you put into the Roth IRA, and there are no taxes due, no penalties. So this is what I'm going to tell you, that if you're not sure if you could put that money aside to make the annual contribution to the Roth IRA, do it. Because regardless, you'll have access to the principal if you need it, and then you still have the growth that's going to stay for your retirement. So between a Roth and a traditional IRA, I'm pretty partial to doing the Roth IRA if you qualify from an income standpoint. only because I look at the accumulation and what you're going to pay in the future in the traditional IRA. And I know some people are going to say, well, take that $1,500 in savings and invest it elsewhere. You want to go for it, but it's really nice to say, I have some money that's tax deferred, some money that's tax free, and different type of investments. It's a further way to be able and diversify. So again, we now have our Roth IRA, we have our traditional IRA, we have the deductibility, we have how they're taxed, and we have the flexibility of how that money could come out. Let's talk about a regular brokerage account. So when you hear brokerage account in itself, all it is think of it like a bag or an account. It's a simple account, and within that account, you could invest in pretty much whatever you want. So if you just want to invest in a money market, you could do that. If you want to invest in stocks, CDs, different bonds, mutual funds, exchange traded funds, brokerage account, you can invest in whatever you want. There are no income limitations in a brokerage account. There's no minimum required distribution that you have to take out of a brokerage account. There's no time frame that you need to wait to take the money out. Some of the individual investments you might have to wait 30 or 90 days, but the account itself is not going to restrict you. Brokerage accounts can be opened individual. They can be opened in joint name if you want. And if you have a company or a business, you could even open them up under an LLC or a corporate name. The nice thing about the fact that you could put whatever money you want into there, there's no income limitations on it. You could invest it however you want. Another huge plus with the brokerage account is that you could eventually set up checking on or do different things if you want. We're going to talk about them further. In a brokerage account, however, you do pay the taxes as you go. What that means is if you've invested in a CD in IRAs, it's either tax deferred or tax free. You buy a CD in a brokerage account, when that interest comes due, you're going to receive a tax form at the end of the year. You're going to pay taxes on that. If you invest in a stock or a mutual fund, the same things. Stocks pay out dividends. Mutual funds pay out dividends as well as sometimes capital gains, even if you don't sell them. We'll have to talk about that in the future. So it is taxable, whatever's happening in it. Now, here's the thing. You're not going to get out of paying taxes. I mean, even if you die, you're still going to have to pay taxes, or your estate does. It is something that we do. So if you're thinking to yourself, oh, I'm not going to invest, I'm not going to put any money in the market because I don't want to have to pay taxes on it, that's a really, really bad reason not to invest. So you definitely want to invest. Just know that the taxes are there. We could do smart investing on smart tax efficient type vehicles, but don't let that single fact stop you from investing. That would be like saying, I'm not going to go out to eat because I have to pay taxes on my food, or I'm not going to buy clothing because I have to pay taxes. It's actually worse because those two you're spending, this one you're saving. So save them. We went over the Roth IRA, the traditional IRA, the brokerage accounts. Those are the accounts that I want to discuss as you're starting out right now, as we're in episode 3. Eventually we'll start talking about college accounts and stuff for the kids, but I think right now primarily I want to cover the individual investor, the actual person, and then other people that you'll be taking care of. Now, we have some time left, so I'm going to go over employer-sponsored plans. So a 401k, a 403b, a thrift saving plan, 401a, they might have different names. Theoretically, they're all employer-sponsored plans. The difference is a 401k is pretty much always offered by a public company or corporation. So if you're working at, I don't know, U.S. Steel, or that's a bad example. If you're working for an automotive company, if you're working for a restaurant, if you're working at any commercial business, you're going to have a 401k set up. And normally what happens is you contribute, you sign up for what percentage of your paycheck you want to contribute into there. And you'll have sometimes a choice if you want to contribute pre-tax dollars or after-tax dollars. And a lot of times the employer will match a certain percentage of the contribution. So that is that is free money that you're getting when your employer matches. So your 401k, employer sponsored plan, almost always is the one that you want to do first, especially if you're getting the match. 403bs are usually offered by university, hospitals, and nonprofit. Same thing. Your own contributions go in pre-tax. If they offer the after-tax, you could do that as well. Sometimes there's a match from the employer as well, so you want to do that. Thrift saving plans, teachers' retirement plans, same concept, different name. There's a few IRS regulations that are a little bit different. So if you can, save in those accounts, primarily if you're getting the match. I'm going to say that if they're not giving you the match and saving the taxes today is not the best choice, I'm more lenient towards saying put the money in the Roth that you have control over it and it's tax-free. Now, if you don't have a lot of self-control, then the employer-sponsored plan is harder to access, and you know that money's going to be there. I know I talk a lot about self-control and things like that, and everyone has their thing. So it's not easy. I have wonderful self-control when it comes to money, not self-control when it comes to dieting. So I get it. It's not easy all the time, but keep up with it. Keep the savings. This is a retirement journey. We're going to do it together, and we'll see what we're talking about next week on my next video.